We help them build their data rooms. We help them understand what information is important, what information is less important. We help them build their reporting systems. We actually in the US run a back office fractional CFO business. So we can set up and run emerging managers' full back office if they want. And that just, again, it helps the manager kind of get set up operationally, but it also helps like the manager report on the data that's important to LPs. And it helps the LPs, right, get better, higher, quality information where they can make better investment decisions. So again, a lot of it comes down to, I think discovery, diligence. And then like I mentioned, another big gap was kind of, a lot of emerging managers don't know what they don't know. So being able to create a program that could train them and create a, fractional CFO business that could help them financially and operationally was important.
Welcome to Finscale, the show that takes you to the heart of finance transformation. Every week, Selene Niederkorn and her guests explore new initiatives shaping the future of the industry. Enjoy the show.
Hello, everyone. Great to have you on the podcast. I'm super happy to have today Winter Mead, the founder of Coolwater Capital. Hi, how are you?
Great. How are you doing?
Great to have you on the podcast. It's been a while.
Here we are. We made it. Great to be here.
Yeah. So for the audience, I had a very interesting conversation with you last winter. Actually, we were discussing the different opportunities in VC fund allocation in Europe. And we discussed what you were launching with your company in the US. And I found it very interesting to have your point of view, to have your opinion on the evolution of VC, not only in the US, but also worldwide. I'm also interested to know more about your positioning, your origin. So can we start by a very, very simple question? What led you to create Coolwater Capital?
Great question. Are there any simple questions? I think the simple questions are yes or no. But what led me to create Coolwater? So my background is mainly as an institutional allocator. Before that, I worked at a couple of startups in San Francisco. But I think the early part of my career was built being an institutional allocator at institutional fund of funds. Investing into a lot of private equity and venture funds, I noticed there was this gap. And it was twofold. One, it was the support side. So, if you're writing larger checks as an institutional allocator, like where do you dedicate time and resources and support? You typically dedicate it to, your larger positions, or even you dedicate time and, allocation to larger positions. But it also felt like it was a gap in terms of, institutional allocators being able to access performance, being able to access the alpha generation opportunity within emerging managers or small funds. And so I felt like those two gaps, the operational support aspect and the performance issue, like the inability for institutions to access alpha and high performance of smaller funds, seemed like an opportunity. And so, for the last few years, we've been building out a platform, Coolwater, to offer just that, like the opportunity, the platform to help and support emerging managers, but also the opportunity for institutions to access and get exposure to and invest into this alpha opportunity that we see in smaller funds.
If you could be more precise in your definition of emerging managers, what do you mean by emerging managers? Is just the launch of the first fund, or warehouse deals before launching the fund one?
Yeah, that's a great question. So emerging managers mean different things to different people. So if you are in venture capital, an emerging manager is typically a micro fund, so a fund that has less than 100 million in AUM, and it's typically defined as Fund 1, Fund 2, Fund 3. And why is it defined as Fund 1, Fund 2, Fund 3? Because it takes a while to demonstrate performance in venture capital. And so by the time you're at Fund 3 or Fund 4, you're able to go to limited partners, the people who invest into your fund, and you're able to say, hey, look at what I did at Fund 1, look at what I did at Fund 2. I'm going to do the same thing. Maybe I'm a little bit larger fund size, but I'm going to do the same thing in Fund 3, the same thing in Fund 4. So, at that point at Fund 4, LPs can see that the strategy from Fund 1 and Fund 2 is working. Now, given that strategy might have shifted a little bit because you might be raising larger funds if you're indeed successful. But I think that's how most people in venture define emerging managers, kind of sub 100 or even sub $200 million AUM funds and funds 1, 2, and 3. Now, if you're an institutional allocator, right, like a big pension fund or a sovereign wealth fund, you have, lots of capital to invest into alternatives. So that's, hedge funds, private equity, venture capital. You typically define emerging managers as something much larger. So it could be $1 billion, less than $1 billion in AUM per fund. So the fund is raising $1 billion in USD. And so some define it as 2 billion, right? I was looking at a research report last week that defined it as an emerging manager. There was an organization putting out some data publicly, and they defined it as just emerging managers. So we're talking about what does an emerging manager mean to different people. Institutional allocators, right? I was talking to a friend. He works at a large pension fund. He invested into an emerging manager that was $800 million.
Yeah.
To Coolwater, an emerging manager is typically sub 200 million, really sub 100 million when you're just getting started. Within venture, it's really sub 100, even sub 50. Within private equity, I would say it's sub 500 because the strategy could be buyout or the strategy could be, large growth. And so you just need more capital to kind of invest at that stage. So that's kind of where we would define it in terms of an AUM. And then in terms of a fund number, it would be kind of funds 1, 2, and 3.
Okay, interesting. Thank you for clarifying. So I know this because I've supported some fund managers, GPs, to launch funds in Europe. So sometimes the friction I see, I rather see operational and regulatory frictions. On your side, what were the main frictions and pain points you identified when you launched first the Coolwater?
Yeah, so as mentioned, I think there's a capital gap, right? There's a lot of institutional capital that's still seeking yield in their portfolios, right? And I think there's institutional capital that's seeking that, and more there's retail investors as well that are diving into alternatives, many through wealth management platforms. And so one of the big friction points is being able to discover emerging managers, right? So not everyone.
Marketing and distribution of the fund.
It's that, but it's like if you're, a wealthy doctor or, you're working in a field that's not technology or not venture capital, how do you find someone, right, that's spinning out of a firm? Because there isn't really advertising there, right? There's kind of word of mouth. And so, Sand Hill Road, if someone's leaving a firm, right, you almost have to be like an insider already, kind of in kind of the, with a brand and in kind of those circles to be able to like understand who's leaving. Because most people, what I noticed, for the last 10 plus years, the good funds, like most of them you see as public announcements when they've had a first or even a last close. So it's too late for a closed-end fund, right? Like a fund that closes and then you can't reopen it to reinvest, right? In public funds, they're typically open-ended. Like you can buy in, and there's no kind of deadline to buy in. Like if you buy into the public market, there's no deadline, right? You might miss out on opportunities because you're investing, the stock keeps going up and you invest at a high price. But in the private markets, you're dealing with closed-end funds, right? So there's a specific timeline in which you as a limited partner or investor have an opportunity to invest, right? So there's some scarcity value per fund. So I think, discovering those funds in a, adequate timeline that allows you to invest into the smaller funds and into the earlier stage vintages, I think that's a big gap. Right. And so, we met with 2011 fund managers via Coolwater last year. We think that's a pretty high number of fund managers. Like if you're a VC fund, I read a lot of pitch decks. People throw around, like I met with, 10,000 companies, or I, use my AI to evaluate like 100,000 companies, or, 10 billion data points. But 2,000 managers is a lot. Most of those are US based. So that number is actually bigger, right? If you kind of think of it from an international perspective. But yeah, I think the discovery piece is, even if you meet with 2,000 managers, then there's like a diligence gap. Like, how do you actually figure out who's the top 10% of that, right? People talk about, if you invest into venture, you have to access the top teams, right? So just thinking about it, would you, if you're investing in public markets, would you rather invest into a top 10% performing stock, or a lowest 10% performing stock, right? I think everyone would say top 10%, right? Because that's the point of investing. But if you think of a stock market, let's say there's 1,000 companies on that exchange. Now, if you only look at like randomly at 10 or 100 stocks, are those the top 100 performing stocks, or are those the bottom 100 performing stocks? You actually don't know unless you see all 1,000 stocks and how they perform in a stock market. And so it's the same thing with private markets. It's just the data is less transparent. And so
and it takes time. It's not day to day. It's taking a lot of time, because the valuations are not done on a daily basis. Not like a market fund.
It's not. Yeah, it takes time. You're right. Like, there's a lag in private markets. There's not as much, I think, readily available operating metrics, right? Because a lot of these companies are earlier. By the time they go public, right, there's already a lot of infrastructure there to be able to collect data and report data, so that investors can make knowledgeable investment decisions on those public stocks. But yeah, in the private markets, there's sometimes not even that data that exists. And so as an LP, right, you're even one more layer removed. And so, what we do with Coolwater is we help investors, get set up, pull together their track records. We help them build their data rooms. We help them understand what information is important, what information is less important. We help them build their reporting systems. We actually, in the US, run a back office fractional CFO business. So we can set up and run emerging managers' full back office if they want. And that just, again, it helps the manager kind of get set up operationally. But it also helps like the manager report on the data that's important to LPs. And it helps the LPs, right, get better, higher, quality information where they can make better investment decisions. So again, a lot of it comes down to, I think discovery, diligence. And then, like I mentioned, another big gap was kind of, a lot of emerging managers don't know what they don't know. So being able to create a program that could train them and create a, fractional CFO business that could help them financially and operationally was important.
Interesting. So it's important, so important in the beginning when the fund grows, and then they raise a second fund or a third fund. Those companies generally insource their CFOs. They are doing their own marketing. They have also a marketing team in place. And at that precise moment, are you still with the fund managers, or do you continue to support them on the funds 2, 3, etc.?
Yeah, it's a great question. So taking a step back, like what you just mentioned there is a 3 to 12 year journey. So I guess for the audience, like the way funds work is like you raise a closed-end fund, you invest it over 2 to 4 years, then you raise your next fund, right? You invest that over 2 to 4 years, you raise your next fund. So theoretically, 10 years could go by and you have 3 to 4 funds kind of under your firm's management. I think the gap, to talk about like what's the friction in the market, the gap is that emerging managers are so focused on fundraising, and right, it's existential in the early days. Like it's the only thing they can think about. So they don't almost care about, maybe they care, right? Maybe that's too strong of a statement, but they don't, I guess for emphasis, they don't really care about finance and operations. It's just not the top priority.
Clearly not.
And And so the other thing is, right, like how do you generate alpha as an investor? Do you generate it by fundraising? Do you generate it by building a great back office, like having a good work process for your like, taxes? No, you do it by partnering with a great founder that builds a very valuable company. Mm-mm. So where is the priority? If you're a GP, if you're a venture capitalist, where should the priority be? The priority should be on investing.
Allocation.
And the dynamics and allocation, the dynamics, though, pull you towards fundraising and pull you towards setting up a business. Because when you go off and you hang your own shingle, when you start your own business as a fund manager, right? Fund manager, management, right? People go to school and get MBAs for years, right? Master of Business Administration. Like you go to school to learn how to administer businesses, I guess. That's what MBAs do. So like where do you go to get a master of fund administration, right? Or fund management administration, right? It's like there is no training program before Coolwater that I could find, right? So again, I wrote 2 books. That was kind of like a gift to the ecosystem to say, hey, this will start you, right? The 0 to 1, this will start you on your path, but it requires a lot more than just reading a book, right? Like read a book about building a house and then go try to build a house. You're going to be like, well, the book was helpful, but it feels like there's some pieces that might be missing, right? Or just pick up any book off the shelf on real estate and then go try to build a house. So
Yeah, there is something that I realized because why you describe this issue is that people are really focused on raising capital and completely forgetting the operational aspects. And when Fund 2 arrives, my feeling is that they realize, but sometimes it's too late, that they have built in a wrong way. And sometimes they decide to, for instance, insource again and recruit, and they lose a lot of momentum. They lose a lot of time and money trying to reorganize the fund and the management company again. So they are rebuilding while they're raising and allocating their funds. So this is something I see very often. They don't necessarily ask themselves the right questions. And this is why I find your Coolwater very interesting, because you really, they can get rid of all that stuff, but what you build with them is very strong. You know what I mean?
It's a choice, right? Again, like if you've never read a book on building a house and you try to build a house, conceptually, you know what a structure looks like that has a roof over your head.
Yeah.
But is it going to be a very strong, well-built structure? Potentially not. I think back to high school, I had a calculus teacher, and the way he taught us mathematics was, right, like you don't start with the roof, right, and then build the floors underneath. You start with the foundation. You start with great business practices. First, you have to understand what the best practices are, or the better practices, because some people challenge when you say best practices. But it's always I guess, a process of improvement. So you start with the better practices or the best practices, and then you have to implement them. So when I co-founded #OpenLP like 10 years ago, which was a movement in the US that basically was like a Twitter hashtag where you could put something out as an LP or talking about the LP-GP relationship, which was less known at that time. And you could hashtag it OpenLP, and it was a content aggregator. So you would aggregate all this information, but again, it's the same thing. And then I wrote a book in 2018, 2019 called How to Raise a Venture Capital Fund, which, helped put together almost like a playbook for how to raise a fund, at least the things you would need to think about to put together. But again, reading and content aggregation is different than implementation. And that's a key point. Yeah. So it's the same thing where like, if you go to school and you take a test, it's different than when you graduate school and you have to get a job and you have to implement those learnings. So the culture of Coolwater is definitely education. We definitely want to instill and educate institutional best practices, but we also want to help guide GPs and fund managers to implement what they just learned, to help them build something that has a really strong foundation. And you can build Fund 2, Fund 3, Fund 4 on top of that strong foundation. That's very important to us culturally.
And in terms of revenue, do you take a percentage of the fees, or do you become a co-GP? What's your positioning towards the GP?
So for the accelerator, it's a paid program. So the business model is more like a fellowship.
Okay.
If people want to come in, we give them about 100 hours of training, and so they're effectively paying for that in terms of time. And then for the fractional CFO business, that's a service business. So it's going to be less than hiring a CFO full time. But I think we know the numbers for lots of funds, and like we know the numbers for that industry pretty cold, and it's definitely a value to do it as a fractional CFO. And another interesting thing there is you can capitalize it against the fund, right? In most cases, if it's work done for the fund, you can't capitalize against the fund if it's like work done for the firm.
And you produce also the reportings, because as a VC fund manager, you need to produce very often reports for your LPs.
Well, it's supporting that. It's usually defined, like the cadence of reporting is typically defined in the limited partnership agreement. That's what it's called in the US, the LPA. So it's the contract between the GP and the LP. That usually defines like the cadence which you legally have to report to your investors. Usually it's on a quarterly basis, although some smaller funds elect to do it every 6 months or even every year. SPVs typically do it every year, like single asset vehicles, special purpose vehicles, as they're called, SPVs. It kind of just depends on how it's defined, but we support that. It's a service to, again, like support the operations and finance for GPs. And then we also have investment funds. So we have 2 investment funds in the US that we have started to invest into this ecosystem. So that's a newer development. We actually started the accelerator without in kind of committed capital, but now we that's another kind of part of the model where, again, like we want to bring more capital network and capital into this ecosystem to support the best, meaning the highest performing, the highest potential small funds.
And in terms of structure, do those fund managers use rolling funds via angel list? What is the most typical structure that you see or that you help building?
Yeah, that's usually how they do proof of concept funds. Like they're kind of, if someone's looking to build a track record, you can do it by, allocating some of your salary, right? If you meet the, regulatory hurdles, allocating some of your capital as a high net worth individual into angel investments, as they're called. And then you build out, a portfolio. We've had people with as many as 160 angel investments come into the cohort. We've had people with as few as 4 investments, right? But those weren't angel investments. Those were institutional investments come through the program. Typically, I think when we ran this analysis year and a half ago, the average was about 12 investments before you came through. So you had felt what it meant to go through that process, and you had done it a dozen times. But what was the question specifically?
I was just wondering. I know the vehicles in Europe very well, so I know what kind of vehicles are built.
Structures. Yeah, so the types of structure. So to get started, there's different. Like rolling funds would be in like the getting started bucket. Angel investments would be in the getting started bucket. SPVs even would be in the getting started bucket. Surprisingly, we have a lot of individuals that come to us that haven't made an investment yet. And they want to, again, like we could theoretically train them. But what I usually give as advice is like, go see if you like investing first, right? Because there's different functions. There's management, there's fund management, which is different than fund investing or just investing. And then there's fundraising, right? Which is different than those two. So there's different functions. It's like, if you've never invested before, right? I get why you could go to school and kind of figure it out. Like you could go to Coolwater and figure it out. But I think like the best intersection is like people that have, done these SPVs or angel investments or rolling funds or smaller funds, right? Or, built a track record with other people's capital, right? Maybe they worked at a firm and built a track record there. That's usually the sweet spot for Coolwater, where you have some you yourself have developed a thesis of like, you like investing. That's more of a personality thing. And then a thesis on like what you think, your skill set is and what it matches to in terms of investment strategy. And you're ready to like raise a fund on top of that. You think you've identified a gap in the market, or you think you've identified a really big opportunity, and you've, demonstrated for years your involvement and your, expertise, and you've built up experience there, and you've built up, frankly, an advantage, right? That LPs are going to recognize, limited partners are going to recognize, and hopefully bet on you for that advantage. When that happens, to finally answer your question, when that happens, what usually happens is those managers go to a third-party law firm, and those third-party law firms all have very similar fund formation documents, like limited partnership agreements, contracts, again, that define the relationship between you, the venture capitalist, and the limited partner. And those lawyers kind of sit down with you, and they kind of, you go through an 1 hour to 3 hour exercise of saying, okay, what do you want your fees to be? What do you want these certain terms to be? Do you want to be more LP friendly or less LP friendly, more GP friendly or less GP friendly? And then the lawyers typically give you back those documents, so you can like review them. That's the most common structure still. There are...
And not the most agile, I would say.
It's not the most agile. And it's, like I said, everyone has a similar but different structure. And so there have been organizations, I'm not going to name names, but there have been organizations that have tried to like basically redefine or just define kind of a standard for an LPA. And even the NVCA, like the Venture Capital Association, like the lobbyist organization for US venture capital funds, they've put out kind of a template. So that's a good one, but still every fund, is a little bit different, and everyone's, again, personality and their kind of belief in what the term should be are probably going to be a little bit different. But there still seems to be some opportunity there to create more of a standard that both, I'd say, protects the GPs and protects the LPs, because that's important. If you start that process working with the wrong team, if you don't understand what market terms are, if you get one of those LPAs or one of those contracts that is not standard or standard enough, you're actually disadvantaging yourself, going to market pretty significantly. And, even if people don't recognize that because you're a smaller fund and people aren't reading kind of the fine print in those contracts, if something arises, right, hopefully it doesn't, but if something arises, you might be actually subjecting yourself to more liability if that's not a trusted, well-known, fund formation lawyer for the venture capital industry. So it's still, that's the typical pathway. It's probably, or I wouldn't say probably, it's the most expensive path to do it. Yes. And like the price can range drastically, like by orders of magnitude, depending on who you work with. But there are people trying to like solve that, but no one's quite solved it, because I think it's a legal thing. There's liability there. And, you are kind of going off and starting your own business, and you're taking lots of capital from other people. And, you probably want to make sure you're working with someone that's, again, trusted and an insider, and those people can command premiums.
Okay. So I had,
sounds like you have some history there.
Yeah, I won't comment. Yeah, I do agree. So you've seen so many fund managers, and so you have a good idea of who are the one really making the difference. So I would be interested to have your opinion on this. What makes such a difference between the top tier one VC managers and the rest? And second question, what are you seeing currently in the LP ecosystem in terms of appetite for emerging managers?
I'll tackle the first one first. So what makes kind of the best VCs? We at Coolwater, like I said, our sweet spot is you already have some track record. Again, we can work with exceptional people if they don't have a track record, but there has to be a lot of ambition and intention there. And that is kind of the exceptional case versus the standard case. The best VCs, or I'd say like, let's start with just the VCs that Coolwater works with. The VCs that Coolwater works with are coming out of investment firms. So in the US, there are literally hundreds of funds. There's even more, but just talk about like the kind of usual names, like not a household name necessarily, but a well-known name if you're in venture capital. There are hundreds of them. And, you know, those firms have anywhere from dozens to hundreds of employees, right? And so you're in an ecosystem that will do some, you know, quick math that has 10,000 people like employed. That's not a large number, like in the grand scheme of any economy, but within venture, right, where it's like this kind of microcosm and vacuum of celebrityism, like 10,000 is a big number, especially if, right, if you look at the number of kind of emerging funds backed per year, like maybe it's a couple hundred, probably less, right? So you have this bucket of these 10,000 people, and yeah, those people are ambitious and they are usually very well trained, very well educated. They're part of this apprenticeship business. They've put in their time, right? And usually probably around like 5 to 15 years into their journey, they start looking around, they see kind of friends that have had success stories. And it's probably the same as like the entrepreneur journey where like you're a really good engineer and you look around and you see your friends like starting and selling companies. I think you look around and you're like, well, that person, I co-invested with them on that and that. And like, I feel like I'm, you know, just as good of an investor. So there's a lot of, they're called spinouts. There's a lot of those people. And yeah, I think you can find great investors there, right? Some of the best VCs have been well trained. And again, they have been well trained as a picker of stocks, so to speak, right? Like they're very good at, you know, identifying high quality teams, understanding what to look for, understanding what the risks are of early stage businesses and kind of like weigh those risks appropriately before making an investment. They've been trained as a board member, right? So they're able to like govern the early stage and like help, you know, with strategy and other things like for the early stage company. So these are usually that's a very high quality pool of potential next generation VCs. And we work with a lot of those.
No, you didn't mention any soft skill. It's funny. You mentioned a lot of mental qualities and not soft skills like human qualities. And at early stage, I mean,
yeah. Well, it's probably my own shortcoming, but I think there are soft skills there as well, right? I think I tried to mention it maybe with the, you know, building the relationship with the founder, like identifying high quality founders, but there's also like the relationship aspect to be able to like, again, access that round.
Why I ask you the question is that it's one thing to be able to do stock picking, but it's another to convince the founder to partner with you. And it's a different story.
Yeah. Well, I mean, that kind of goes with it, but it's a great point and something I totally agree with, where you need to have great sales skills to be a really strong emerging VC. And you learn what that process looks like. Maybe that's soft skills. Maybe it's just a skill. Yeah. It's soft skills, like to be able to look at and work for a well-performing VC that's been in the industry for 20 or 30 or 40 years. And again, emulate that, like what it took for that person to be super successful. And you've been on the inside of that, right? So you've seen these are the best performing investors. They've survived for decades. You've trained under them, right? And so you can emulate that behavior. And if you haven't had, that's the apprenticeship business, right? If you haven't had that understanding of, you know, how good cobblers make shoes, right? You can figure it out, but it's probably going to take you longer to figure out. And most likely you're going to have like your own unique style, which might be differentiated. But if you just went and trained at, you know, the best cobbler in Italy, right? You're probably going to like understand what great looks like and get to like a very high level very quickly. So that's a really, you know, we're kind of getting bogged down in that one category. The other category is venture is very unique, right? I'm assuming this is a venture oriented audience, but venture is a very unique part of alternatives. It's not private equity. I'd argue for most emerging managers, it's not even growth. And it's not other parts of the alternatives markets. It's like a very unique business where, to your point, soft skills matter, relationships matter. They're almost consummate for the ability to get access into rounds. But there's also, I'd say, a lot of personality in venture, right? And sometimes that means more personality than transactional orientation. Meaning like someone who's a founder has a very strong personality and says, well, that person I don't relate to because their background is consulting and finance. Like I relate to this person who has, a builder's mentality and a founder mentality and a founder background. They've like gone through the pain that I'm going through. They understand me, right? And I want them because I just think like they've done it before. They've been there, done that. They're going to be able to, empathize, encourage, work with me, help guide me. And they also almost have had the ego removed from them, right? Where some people, if they sit in the boardroom too long, there might be this element of like, I know it because I've seen it versus like, I know it because I've done it. And actually, because I've done it, I don't even know it, right? I'm here to guide you. Like, I can't tell you. Like, it's your baby. It's your business. And so I think there's like the second category, right? Hopefully that emphasizes the soft skills a little bit more of like the operator within VC that understands the founder, right? And has many times like a unique skill set. That could be, again, sales and marketing, helping growth, go to market. That could be product. That could be technical. That could be a unique network to help like early hires. So something that's exceptional, but it comes from almost like the operator founder. Like I'd bucket them in the same one. But those, there's Coolwater is, I would say, argue is more helpful through the program for that type of background, like founder turned VC, because we offer multiple, like the comprehensive playbook. If you want to like go from zero to hero very quickly, like that's what we do. It's like, hey, you've been amazing. You've built this, you've struggled, you survived, you succeeded. You now want to like give back to the ecosystem by being a venture capitalist and take what you've done and the skill set you've built and apply it now to many other founders to help those founders. Coolwater can help you go from zero to hero very quickly in terms of like, okay, you don't know the skill set of being a fund manager. You don't know what you don't know, even though, you're one of the most successful people on earth, but we can help you kind of figure that out very quickly. And those people are very competent, very quick learners most of the time. Again, still ambitious, despite the fact that they've many times been like financially successful, just because they're builders, right? So I think that's a really key point.
I had another question on the risk appetite of LPs towards emerging managers.
Yeah, I'm going to get to that, but the third category is
you have three categories. Sorry,
yeah, three categories. I know I haven't lost the second question. This is what happens when you ask two questions at the same time. I have to answer the first one to get to the second. We're still climbing up the ladder. And the third bucket that I find like very interesting, and I think Coolwater is actually very good at this, and that's been kind of proven over the last 5 years, is this bucket I call like diamonds in the rough. And I think some people categorize it as non-traditional backgrounds, meaning you're not spinning out of a traditional fund, or you aren't kind of a senior exec or kind of a senior successful person within venture already. And we've had people come into the program who've worked at nonprofits. And again, like you have to have a perspective of how to generate value, right? You could be a professor. You could work at a nonprofit. You could have some skill set that in today's market might be even more valuable to founders than it was, 2 or 5 years ago. So this is, and I think this was a category, if we're talking about gaps and kind of why I start Coolwater, this felt like, people talk about diversity and they talk about backing people from non-traditional backgrounds. I have not seen a pattern of institutional capital at scale backing these types of investors because it's so hard, like I said, to discover them, to give them a voice and a platform, to give them the opportunity to kind of figure it out, to train them to know what they don't know yet, to offer them the ability to like build something so that it's a product that you can actually sell, right? Again, if you don't know how to build a house, can you build a house? If you don't have the materials to build a house, can you build a house, right? If you don't have the support to build a house, can you build a house? Coolwater offers all of that to these diamonds in the rough. And then, right, then they have the product, they have the house, and then you can go sell the house in the market, right? Like you have the fund, and then you can go sell the fund product on the market. So
this third category would be rather like an advisor of founders.
No, it could be anyone. I wouldn't even think of it as an advisor. It's really just like, it's an open-mindedness. Like if you've ever done a research program, like in graduate school, it's kind of the idea of, right, there's all this history of what other people have written and all this research of what other people have researched. Okay, so how do you develop any new knowledge? How do you contribute to humankind if all you're doing is, entering your text prompt in ChatGPT and it's giving you back public information that's already been generated? There's no new generation there, right? And so the idea here is it's like an open-minded category to say like, hey, venture sometimes struggles with performance. That's one topic of debate. That's not the only topic of debate. But one topic is like, why would I lock my capital up, to get 22% IRR net when I could get 15%, net compounded if I do this other asset class, right? So it's an open-mindedness to say like, well, could you do it a different way where you could get 25% or 35% IRR? And like, who's to say if you've been trained how to build a house a certain way and you come out, right? Or you've worked in that industry building houses, right? And you've been in all the trade organizations and associations and you've been inculcated with all that information. Your house from those first two categories is going to look very much like any other house.
Yes, clearly. But I was just wondering because, sometimes LPs are risk averse. So they know they allocate pockets in VC.
Well,
so they are
absolutely. To get to the third one. So yeah, so LPs are going to, I'd say, disfavor that third category the most. In terms of priority of where an LP will spend time. And this is true. I think I'm making 5 investments this week into funds. It's the funds that have the most success are those traditional spinouts still, but that's not a change. I've been in the industry for 15 plus years and I've invested into over 200 funds and the majority of those are emerging managers. And that is not a change. And I've worked at 2 institutional shops that are very big and wrote very large checks into lots of institutional managers. And like, if we were to do an emerging manager at an institutional shop, it would be into someone that looked like that. And again, it's just because these people know what they're doing. There's less risk on there's less investment risk. There's less portfolio risk. There's less, how do you actually run this type of business risk? There's less, recruiting risk if they're going to build out an organization, recruit a team. There's less, track record risk, right? And there's just like more time saved because to figure out right from that diamonds in the rough, okay, what is your actual skill set? What do you actually do? How does that contribute to the ecosystem? How does it help founders? Why are founders going to let you in on the cap table? Those are different dynamics than just like, oh, you worked at that firm and it's clear, you have 20 great portfolio companies in your portfolio. You're leaving. The biggest risk is like, okay, was it the firm or like someone else at the firm that helped you get access into those companies? And now that you're standalone, are you still going to get access? That's like the biggest kind of, but it focuses LPs to like figure out one thing during the diligence process. It's like, are you a rock star or was your firm, or were you a rock star because of your firm? Right.
Yes.
It's like you had a track playing on the background. You're up on stage, you're doing your like playing the guitar, but it's like an air guitar and like the band is taking care of everything. And there's a singer off stage, like, that's your voice, but it's like, you just look better because you have long hair as like a rock star. And so people are like, oh, that person is the rock star. But then you're like, oh wait, they actually don't play an instrument. They don't sing. They're not even that good at dancing. It's like, when you leave and they don't have a band and they don't have like the second, singer and like all like, then it's like, oh, they're standing alone and it's the emperor with no clothes. And so
Yeah,
I think and so that's the thing that LPs try to figure out during that spin out phase. I think if you've already built something, right, it's the same thing. It's like, okay, what role did you play at this startup? And that's a very easy thing for people on the inside to diligence. They call up someone else. They're like, hey, was this person a rock star at this company, or like, what's their deal? And they're like, okay, well, they run down the list. But yeah, the diamonds in the rough are much harder, right? If you think about the diligence process of an LP, those first two categories are actually fairly streamlined.
Very plain vanilla.
Well, all you're trying to figure out is like, is this person a rock star or not? Like, are they the ones doing the singing, or are they playing the instruments? Right. And if the answer is like, yes, then, I feel like there's the opportunity and the probability to move forward in that process. But for diamonds in the rough, like these other funds that Coolwater works with a lot, much harder for an LP to want to spend the time, right? To believe that it's worth the career risk to spend time on these opportunities, right? It's just like, there's enough. I think there's been something, I'm going to get the number wrong here, so audience can correct me, but I think there's been something like 40 spinouts from tier one funds in the US since last July.
Wow.
So think about that. That gives you an opportunity set as an LP to look at 3 fund investments per month over the last year, just coming from tier one firms. And how many new checks do institutional allocators write per year? Not more than 4, right? I would argue, like, if you put that on a graph, it would be like infinitesimally small by the time it got to 4 new investments. So, that's 10% of just the category 1 type I described. And so I think it's not even like, people categorize it maybe too high level, where they're just like, it's LP aversion, but it's like, well, the market's just bigger and the LP category hasn't caught up to the GP market, right? Coolwater exists because there's so many GPs to support. But the LP market is like the kind of second role of Coolwater is to help educate LPs and help them understand what the opportunity is here. Both from the institutional perspective, we've tried to build a platform that identifies institutional investment opportunities, right? If you're an institutional allocator and you want to invest into emerging manager funds, we can help you identify and diligence and build a portfolio of, 40 tier one spinouts in a single year. If you wanted to, right? You can kind of like, pick your poison. But that's not how LPs really invest. And I think the other piece is, it's a compounding effect of, decision paralysis because the market's gotten bigger, longer duration, right? So if you are VC oriented, you're predisposed to invest into VC and you've kind of built conviction in VC. If someone gives you $100 back, right, maybe you reallocate that into some other stuff. Like you put some into real estate, you put some into public markets, maybe you buy something with it. You might have like $15 left over. You put that $15 back into VC, right? But if you all of a sudden have longer duration in the asset class, you don't have that $100 back, right? Or you have less, you have $80 back, right? So now you're negative $5 if you're following the math, or let's say you get $85 back. We'll keep the math simple. So that $15 that would have been recycled into emerging managers, right, is no longer there because like exits have been pushed out, like timelines for funds have been elongated. So I think this is kind of the dynamic, right? And then there's 2 sides to that coin. So the debate is like, well, venture works well because of compounding, but then new LPs don't come into venture because of long duration. Like those are antithetical. Like those are diametrically opposed. Where it's like, so then you have dynamics of new LPs saying like, hey, you've got to sell secondaries, you've got to sell positions super early. And then you have people who are kind of like purists, let's call them LPs, who are old school, saying like, well, actually, in order to get a 4x return, 20, 30% net compounding over 10 years, like that's how you get venture returns. If you want to outperform the public market, you don't do it in year 1 or year 2, right? You're actually like well underperforming at that point. You have to wait for years like 7 through 10 or 7 through 12.
Of course.
And so there's these dynamics at play where like new LPs coming in, it's like they want different things from venture than old LPs, but the old LPs I'd say are less liquid because it's become a longer duration asset class. And then again, it's just like there's so much that's new here. To really figure it out would cost an endowment or foundation probably a couple $1 million a year to basically set up what Coolwater figures out, right? Just because it does its business. It just like talks with 2,000 fund managers. It works with 100 through our accelerator. It kind of keeps track and tabs on like who's doing what and when and where and how and why, right? And like a lot of institutions to diligence 2,000 opportunities, it's just kind of like, you know, they fall back on heuristics. And the heuristic is like, okay, I know that person. I've invested in that fund for 30 years. That person's spinning out. I guess we'll add some diversity to the portfolio. And that's how they add diversity to the portfolio from my perspective. Again, that's a bold statement. So I'm willing to kind of, I guess, debate that and like talk with people about that, and have a conversation about that and, you know, where I might be off with my thinking.
You were talking about, I have so many questions, but we're running out of time. You know, generally my episodes last 35 minutes. We already had 50. Winter, I always conclude with a book or a podcast recommendation. So what would you like to recommend us today?
I'm reading Zig Ziglar. So I didn't even know who it was. He's like a famous salesperson who did all like these sales courses. But I just saw like a quote and I was like, oh, that's a pretty cool quote. So I researched him and then I found out he had some books. So I started reading those. And then I was at a conference in New York last week. And there was, what is it? Michael Madden? Who's the shoe guy? You know what I'm talking about?
Yeah.
Steve Madden. So he was talking, sorry, there's a lot of speakers. And I've read his autobiography over the weekend because he was like an interesting enough character. He started off as like, just like a cobbler, kind of, you know, looking at other people's shoes and trying to figure out like how to improve the designs. And he built like a multi-billion-dollar kind of business empire on the consumer side. So he just was like an interesting person at the event last week. So I read his book over the weekend. But I like to read autobiographies, biographies, and a lot of nonfiction.
Thank you, Winter. Was, I guess, the longest episode ever.
Great. Do I get a plaque for that or something I can put on my desk?
No, thank you so much for your time. It was really interesting.
Thank you. It's great being here. Thanks, everyone.
Thank you for listening to Finscale. Don't hesitate to subscribe to the newsletter on Substack to stay up to date with the latest innovations. You can also find the podcast in audio format on all listening platforms and in video format on YouTube. See you soon with Solène Niederkorn.